On May 1st, 2026, the S&P 500 closed at 7,230.12, another record, while the Nasdaq finished at 25,114.44. The market was not just reacting to another AI headline, it was asking whether the huge AI infrastructure bill is finally producing revenue. Alphabet gave the market the first clean receipt. Google Cloud reached about $20.0 billion of quarterly revenue, up 63% from a year earlier, and cloud operating income rose to about $6.6 billion. The stock jumped almost 10% after the report and is up about 23% this year. AI demand is showing up inside a profitable cloud business, not just in spending plans. AWS made the signal harder to dismiss. Sales rose 28% year-over-year to $37.6 billion, and operating income reached $14.2 billion. Amazon shares rose a little over 1% on May 1st and are up about 16% this year. That does not prove every AI project will earn a return, but it does show enterprise demand reaching more than one cloud platform at scale. The spending scale is now the price of admission. Google, Microsoft, Meta, and Amazon are expected to spend roughly $725 billion on capital expenditure in 2026. The market is no longer debating whether the build-out is large. It is debating who can earn enough from that build-out to justify the bill. That is why the checklist has changed. High Capex can be a moat when revenue follows. It becomes a burden when free cash flow, buybacks, or balance sheets start carrying the weight. Investors are now watching cash generation almost as closely as cloud growth. Meta kept the warning visible. First quarter revenue rose to $56.31 billion, but the company lifted its 2026 capital spending outlook to $125 to $145 billion. The stock slipped 0.5% on May 1 and is still down about 8% this year. Strong growth helps, but it does not erase the Capex question. The market wants returns, not just ambition. The next verdict moves to suppliers. AMD reports after the close on May 5th, with Wall Street looking for roughly $9.8 to $10.0 billion of quarterly revenue. If cloud demand is real, investors will look for signs that it is reaching chips, server platforms, and the broader AI hardware chain. The market is also checking the outer rings of the AI build-out. Lumentum reports on May 5th, giving investors a read on optical components. Rocket Lab reports on May 7th, with first quarter revenue guidance between $185 million and $200 million. These are not the obvious cloud names. That is the point. The real rotation test is not whether investors can name more AI beneficiaries. It is whether those companies can show orders, revenue, margins, or better guidance. The rally gets healthier when proof spreads beyond cloud. It gets weaker if money rotates only because investors are chasing the next AI ticker. Trade policy added a separate warning light. President Trump said he will raise tariffs on cars and trucks from the European Union to 25% next week, above the 15% ceiling from last year's framework. That does not change the cloud earnings story, but it can still pressure inflation, margins, and global demand. SanDisk gave the supplier story a cleaner storage angle. Fiscal third quarter revenue reached $5.95 billion, up 97% from the prior quarter, with data center demand driving the beat. Its stock jumped 8.3% on May 1st, touched a 52-week high, and is up about 400% this year. The move is extreme, but it explains why the market cares. AI demand is starting to look like capacity reservations, not just short-term orders. What changed today is the confirmation pattern. Alphabet showed the first strong cloud receipt. AWS made the signal broader. Now the harder question is whether the rest of the AI supply chain can produce the same kind of evidence, or whether investors are extrapolating from two very strong cloud platforms. From here, watch 5 things: AWS growth durability, Google Cloud margins, Meta's Capex discipline, AMD and Lumentum earnings on May 5th, and whether storage demand keeps confirming the AI build-out. The rally can keep working, but only if more companies turn AI spending into measurable demand.